The final week of trading for 2025 opened with a modest pullback, catching the attention of investors and analysts alike. After months of seemingly unstoppable gains, the market's relentless climb finally hit a speed bump, prompting many to wonder if this was simply a pause or the start of a new trend. The opening bell rang to a different tune, snapping the market's relentless climb and signaling a shift in sentiment. The air on Wall Street was noticeably different, less exuberant, more contemplative, as traders watched the numbers turn red. After a record-setting run that saw major indexes reach new heights, investors returned from the holiday break to see red across the board. The S&P 500, Dow Jones, and Nasdaq all opened lower, a visual reminder that even the strongest bull markets need to catch their breath. For many, it was a reality check, a reminder that markets don't move in a straight line. Monday's dip wasn't triggered by any shocking headlines or economic data. Instead, it was a classic case of profit-taking and consolidation. With the S&P 500 inching ever closer to the symbolic 7,000 mark and the Dow setting fresh all-time highs, many investors decided it was time to lock in some of their impressive gains. Traders recalibrated their strategies, reviewing portfolios and making adjustments to protect profits. The mood shifted from euphoria to a more measured caution as the market digested its recent surge and considered what might come next. The decline was enough to spark conversation across trading desks and newsrooms alike. Was this a healthy pause, giving the market a chance to consolidate before another leg higher? Or was it the first sign that the rally was running out of steam, with more volatility ahead? Instead of another surge, the market chose a modest retreat, highlighting the delicate balance between momentum and caution. Bulls and bears debated whether this was just a temporary setback or the beginning of a larger correction. As 2025 drew to a close, attention turned to the bigger picture. Was this dip merely a brief blip in an otherwise historic year, or a sign that the tides were beginning to turn? With just days left in the trading year, investors braced for what could be a pivotal week, knowing that the final chapter of 2025 was still being written. Numbers told the story. The Dow dropped 249 points, or 0.51%, pulling back from last week's record. The S&P 500 slipped 24 points, a 0.35% decline, just shy of the 7,000 milestone investors had been eyeing. The Nasdaq, led by tech, fell 119 points, or 0.5%, marking the sharpest drop among the major indexes. Tech's stumble was especially notable, as it had powered much of the year's rally. Market breadth confirmed the pullback. On the NYSE, decliners outpaced advancers 1.6 to 1. On the Nasdaq, it was 2.4 to 1. This wasn't just a few big names falling. Most stocks joined the retreat. The day's numbers underscored a broad, market-wide pause as the year wound down. The day's market action revealed a striking split among sectors. Technology and consumer discretionary stocks led the decline, while energy shares surged ahead. This divergence set the tone for a session marked by sharp contrasts and shifting investor sentiment. High-flying tech names like Nvidia, which had been on a remarkable run for much of the year, dropped 1.2%. This move signaled that investors were locking in profits after a period of extraordinary gains, perhaps wary of valuations that had climbed to dizzying heights. Tesla, another market darling, reversed course after recently hitting a record high. The stock tumbled 3.3%, dragging the entire tech sector lower and underscoring just how quickly momentum can shift, even for the most celebrated companies. The pullback in these tech giants was a stark reminder of the market's volatility. It showed how investor sentiment can change in an instant, especially when stocks have run up so far, so fast. For many, it was a wake-up call about the risks of chasing recent winners. In sharp contrast, energy stocks gained nearly 1% as oil prices jumped 2%. This made the energy sector a rare bright spot on an otherwise turbulent day, attracting investors looking for stability and growth outside of technology. Meanwhile, financials and materials also slipped, with Citigroup down 1.9%. The banking sector faced renewed pressure as concerns about interest rates and economic growth weighed on investor confidence. Mining stocks were hit hard by falling gold and silver prices, adding to the day's losses in the materials sector. The drop in precious metals reflected shifting expectations about inflation and global demand. The divergence between sectors highlighted how powerful forces like sector rotation and commodity price moves can shape the market's direction. Investors and analysts alike debated whether this was the start of a broader shift or just a temporary blip. For now, energy's rise offered a safe harbor for those seeking shelter from tech's volatility, while the stumble in technology stocks served as a reminder of the risks involved in chasing the market's biggest winners. The day's action left many wondering what comes next. The complexity and unpredictability of today's market were on full display as investors navigated a landscape shaped by rapid shifts, sector rotations, and the ever-present search for opportunity and safety. Individual stories stood out amid the sector shifts. Tech and AI favorites like Palantir fell 2.4%, not on bad news, but as investors cashed in big gains. Tesla's reversal after a record high weighed heavily on the indexes, showing the double-edged sword of market concentration. Bank stocks like Citigroup also slipped as profit-taking set in. But there were winners. Digital Bridge Group soared nearly 10% after SoftBank agreed to acquire it for $4 billion. Energy stocks broadly rose, offsetting some of the tech-driven losses. The day's action showed how profit-taking, M&A news, and sector rotation can create a mixed landscape, even in a down market. Winners and losers emerged from a blend of broad trends and company-specific catalysts. Monday's trading was marked by low volume. Just over 13 billion shares changed hands, well below the 20-day average. The holiday season meant many traders were away, leading to quieter, less volatile markets. With fewer participants, even small trades could move prices, but conviction was lacking. The market drifted lower as profit-takers outnumbered buyers, typical for this time of year. Major announcements were scarce, and economic data was light, adding to the subdued mood. Low volume suggested the dip was more about seasonal quiet than panic selling. The real test for market direction would come when full participation returned in January. For now, the pullback looked like a gentle consolidation, not a sign of deeper trouble. Analysts largely shrugged off the dip, calling it a healthy pause after months of gains. Hank Smith of Haverford Trust saw the tech pullback as a buying opportunity for long-term investors, noting strong fundamentals in most leading names. He argued that, aside from a few outliers, valuations were justified by growth and market dominance. Peter Oppenheimer of Goldman Sachs added that a major downturn usually requires a recession, which forecasts don't predict for 2026. With the Fed expected to ease policy and the economy still expanding, the bull market's foundation remains solid. Experts agreed. After a long rally, a breather is normal and even necessary. The message was clear: don't panic over a single down day. The underlying trend is still upward, and this dip is likely just a minor bump. The timing of the dip put the Santa Claus rally under the spotlight, a period when stocks usually rise in the last 5 days of December and first 2 of January. With a soft start, some wondered if the rally had already happened in the weeks before, as the market posted its 8th straight monthly gain. Profit-taking suggested investors might be unwrapping their gifts early, making for a quieter holiday stretch. Still, the official rally window had just begun, leaving time for a late-year rebound. The Santa Claus rally is seen as a barometer for the year ahead, so all eyes were on whether the market would finish with a flourish or a fizzle. The outcome remained uncertain as the year's final days ticked by. As the year ends, investors are eyeing a few key events. The release of Federal Reserve meeting minutes could offer clues on future rate cuts, potentially moving markets in a quiet week. Jobless claims data will also be watched for signs of economic strength or weakness. Investors hope for a Goldilocks number, steady but not too hot or cold. Beyond data, market behavior itself will set the tone for January. Will buyers step in, or will profit-taking continue? How the market closes out December will help shape sentiment for 2026. For most people, a down day in the markets can feel unsettling, especially when headlines are filled with talk of volatility and uncertainty. It's natural to worry about your investments when you see red numbers and falling charts. But it's important to remember that context matters. A single day rarely tells the whole story of your financial future. Monday's dip was actually a normal pause in what has been a remarkably strong 3-year bull run. The S&P 500 is still up 17% for 2025, which is a significant gain by any standard. When you zoom out and look at the bigger picture, these short-term declines are just small bumps along a much longer road of growth. Markets never move in a straight line. Pullbacks and corrections are a natural, even healthy part of the process. They allow the market to reset, shake out excess, and prepare for the next leg higher. In fact, these fluctuations are what create opportunities for disciplined investors. If you look back over decades of market history, you'll see that every bull market has experienced its share of dips and corrections. Yet, over time, the overall trend has been upward, rewarding those who stayed invested and didn't let short-term noise dictate their decisions. That's why long-term investors should focus on their goals and maintain a diversified portfolio, rather than reacting emotionally to short-term swings. Diversification helps smooth out the ride, reducing the impact of any single sector or stock's performance on your overall wealth. For example, while technology stocks led the recent dip, gains in energy stocks helped offset those losses. This is a clear demonstration of the value of a balanced portfolio. When one area struggles, another can provide stability and growth. The fundamentals remain strong. The bull market is still intact, the economy continues to grow, and the Federal Reserve is poised to support the markets with potential rate cuts. These factors all point to a positive outlook for investors who stay the course. The lesson here is simple: stay the course, keep your perspective, and let patience work for you. Reacting to every headline or market move can lead to costly mistakes, while a steady approach is more likely to pay off in the long run. Daily headlines will always change, and market sentiment can swing wildly from optimism to fear. But a sound investment strategy, built on clear goals and diversification, is designed to endure through all kinds of market environments. As 2025 comes to a close, the best move for most investors is to remain invested, stay focused on your long-term objectives, and look ahead to new opportunities that the future may bring. Remember, your financial journey is a marathon, not a sprint.